this company, AGNC, is paying a dividend of about 14%, close to 14%. The price to earnings is around 11, and the market cap is 9.3 billion. Year to date, we can see the stock price is up 11%. Now, the important questions are, can you rely on this nice dividend of 14%? And can the revenue and earnings grow more in the future? If the answer is yes for both of them, then you can easily put your money in this company. While you wait for an increase in the stock price, you also get a nice dividend close to 14%. And more importantly, if you look at the stock price over the years, it has declined quite a lot. Stock price was about $19 in 2020, and then down to $10. So you might get also a double in the stock price. And it all depends on, guess what? Interest rates. If you look at this company, what they do, AGNC investment, you will find out why they depend so much on interest rates. Now, to start the description of this company, AGNC Investment Corporation provides private capital to housing market in the United States. As interest rates went up from 2020 to 2024, went up from 0 to 5%, also their costs and the demand for their loans have decreased. So, when these rates will go down, the demand will get higher and they will be able to generate more profits in the long term. As you can see here, the company invests in residential mortgage pass-through securities, for which the principal and interest payments are guaranteed by the United States government. And by the way, this company qualifies as a real estate investment trust for federal income tax. This means that 90% of their earnings would be distributed in dividends. So if they make 2 billion in earnings, 90% of that 2 billion will be paid in dividends. So also the dividend may get higher from this level of 14% if they make more money. So if you have an increase in the stock price, of course the dividend will get lower, but be aware, you paid a price around $10. Even if the stock price goes to $20, your dividend will be around 14% because of the price you paid at the beginning of your investment. So this dividend will also increase more in the future. Now, to answer the first question, is this dividend sustainable? Now, let's also look at their past history. Their dividend for AGNC. And as you can see, the dividend, they continue to pay dividends over the years. Let me show you here. From 2012, they've continued to pay dividends to 2025. And the most important thing is that the dividend is paid monthly. If you look on their website, Investor Relations, you can see that this company pays a dividend every month, about 12 cents so far. You can see here. So if you go back, look at their history, you can see that this dividend is reliable. They've continued to pay this dividend around 12 cents. Of course, before 2020, the dividend was higher, 16 cents, 18 cents, and so on. So you see a decline in their dividend, but also because they were impacted by those higher interest rates. As the market expects a decline in interest rates, guess what will happen with the stock price of this company? It will go up, it will increase. It may reach again $18 per share. Now, if you look at their history, financial history, look at their revenue, you can see that it's quite volatile. Because the revenue consists of let me show you here, you better see here, the interest income they get from their loans, and of course interest expense. You subtract interest expense from the interest income, and that's their final revenue, net interest income. When it's positive, you also subtract their expenses, and what's left goes to shareholders. So as you can see, for the last 3 years, their final earnings were quite volatile. In 2022, they had a loss of 1.2 billion, then a profit 42 million, and then a profit of 731 million. Now you have to ask yourself, what do they own? What type of loans, assets? How do they generate that interest? And if you look at their securities, you can see that, as I said in the description of this company, they offer mortgages, loan mortgages. You can see here their total investment securities of about $76 billion. You can see here amortized cost and the fair value. And then on the third column, average coupon, the interest they get on their loan. So as you can see, the amortized cost was 76 billion, the fair value 73 billion, and the interest they get on those loans is around 5%. Compare this to 2023, you can see an increase in their loans, also in their fair value from 60 billion to 73 billion, and also an increase in the interest they get from their loans. Now, this is the interest they earn, and on top of that, interest income, they get that interest income of about 3 billion. So if you do the math, 5% to 70 billion mortgage loans, you will get an interest around 3 billion. But of course, they also have to pay the interest expense, which for the last 3 years was about the same, sometimes even higher. And this is the key. When they will report a higher net interest income, the stock price will go up. If they don't report a profit, final profit, the stock price goes down. And by the way, they also earn some money from derivatives instruments. You can see here. For instance, for 2024, it was around 2 billion. They are trying to hedge their investments based on the interest, how they move, and so on. So the key here is stability. If they have this stability, low interest rates, or maybe also higher, but to have this stability. If they have stability in their interest rates, they can make a profit. If you have those ups and downs, then they are not able to make a profit, because it takes time to balance those interests, the income and expenses. Now, you also have to ask yourself if this is a good investment. And as the interest expense is so high, how are they able to pay their dividend? If you look over the last 3 years, cash dividends paid were about 1.2 billion, 1 billion in 2023, and 869 million in 2022. But if you look at their final earnings, especially from operations, you can see, especially here, net interest income, were with minus, quite lower than their dividend. So how come they're able to pay their dividend of about close to 14%? Well, let me show you something. Here you can see shares outstanding, right? From 2010 to 2024, AGNC investment. And you can see that for the last, let's say, 5 years, this number has increased from 500 million to close to 800 million. You can also see this here, 500 million to 786 million. Now, another important fact is, you can see here, net proceeds, the money they get from the common stock issuances, the money they raise from the market. And if you look for the last 3 years, they raised in 2024 1.9 billion from the market. For instance, they issue more shares to raise money from investors and to pay that dividend, cash dividend of about 1.2 billion. 2023 raised 1 billion, paid 1 billion in dividends. 2022 raised 500 million and paid 800 million in dividends. So as you can see, this dividend, most of it, is paid from the shares issued. To tell you more simply, they take money from you right now, pay you this dividend about 13%, but you also lose in value over time because they issue more shares and they have to divide the profits to more people. So overall, your return won't be that great. Only if you see a rebound back to normality in the interest rates, if they go down and stay stable, then the stock price can double from this level. And of course, they will continue to pay this dividend, but be aware you will have more dilution over time. Just look from 2010 to 2024. You will have this dilution. You will get this dividend, it's sustainable, but they will pay this dividend with your own money by issuing more shares. And this is what I don't like about this company. Of course, the stock price can double if interest rates go down and they stabilize their return. Stock price can double. But over the long term, I don't see this as a great opportunity. Even if you look at their annualized total stock return since May 2008 IPO, can see that the return was around 10% annualized, higher than the S&P 500 Financials Index. Now let's look also the stock price. You can see it. There is from 2008 IPO, stock price was about $20 and now it's down to $10. So the return is not 10% up to date. It's a decline, total decline of 48%. And this happens because more dilution, and in the long term, your value decreases. So this is the risk with this company. It's up to you if you like to speculate, if you believe that interest rates will go down and you're able to make a higher profit in the future. The stock price can double back to $20. There is a possibility. But if you also look at the risk, how they handle this business over time, you'll be more careful. So that's it for this video, and if you have other questions, please let me know in the comments.